Welcome to the market update for the first quarter. At our last update in January, we noted the high level of market uncertainties that would likely result in higher volatility than we experienced in 2021. Indeed, the start to 2022 has been very volatile, with three key themes: inflation, rising rates, and the conflict in Ukraine. While COVID has finally diminished in terms of a market driver, the hangover from COVID policies to support the economy is lingering and is in part responsible for the continued high levels of inflation we are seeing globally. To combat inflation, global central banks are raising rates sharply, and the U.S. started rate hikes last month. Most analysts thought a war in Ukraine was a very low probability. It is now looking like a once-in-a-generation event that will have an impact for years or even decades. In the short term, it has further hurt supply chains and is putting further upward pressure on energy prices. Longer term, the Ukraine war has further exacerbated deglobalization that we have seen pre- and post-COVID, and has further implications regarding energy security, defense spending, and a possible reorder of the global powers. For the past year, I've mentioned that it will be a relief to never show a COVID slide again. And at the risk of jinxing us all, this may be the last one. Looking at the chart on the left, you can see COVID numbers have collapsed in terms of new cases and deaths. On the right, we have a new chart of high-frequency economic data: credit card transactions, hotel occupancy, seated diners, and TSA traveler traffic. All four are above or near pre-COVID levels, and credit card transactions are sharply higher, very positive for growth, but also for continued inflation. Looking at equity returns on the quarter, they're negative, but note they're off their worst levels of the quarter by a significant amount. The S&P 500, for example, was down 4.6 on the quarter, but at its lowest was down about 13%. The Russell 2000 Small Cap Index closed down 7.5%, but was off 14% in both January and in March. Sharp losses early in the quarter were driven by continued and rising inflations, with further supply chain and energy concerns on the back of the war in Ukraine. The rising inflation expectations has prompted the Fed to become very hawkish, which I will cover shortly. Given Russia's position as a major energy exporter, prices rose sharply in Q1 along with uncertainty, especially after the Feb 24 invasion. When the fighting started, most expected a short and swift victory for Russia. But as the war rages on, the human toll rises, and there is a great deal of uncertainty around globalization or deglobalization, also energy security, and the global order between powers, which is looking more and more like another Cold War. Specifically, we may see a future with closer ties between Russia and China, while the NATO countries are unifying against this Russian aggression. Note the worst performing sector in equities was the mega-cap stocks at negative 12%, which is a continued underweight in the U.S. equity portfolio here at Wespath. Looking at the price-to-earning ratio in this chart seen on the left, the green shows that the top 10 stocks have a valuation at 30 times earnings versus the S&P index at 19.5 times. The weight of the top 10 stocks is just under 31%, the highest percent in 25 years. But looking at the earnings contribution at the bottom right, it's fallen sharply from 34% to 24%. This helps explain some of the underperformance of mega-cap stocks in Q1. For international, the MSCI index was down just under 6%, in line with the performance of the U.S. Note that the outlook for international has changed with the Ukraine invasion, with weaker growth expected in Europe, given the rise in energy prices and both their proximity to and dependency on Russia. However, other parts of the world look attractive, especially countries that have natural resources and are energy exporters, like several countries in Latin America or Norway. China continued to underperform, down 14% on the quarter. This on the back of the nation's regulatory campaign, concern about removal from U.S. exchanges, and the zero COVID policy that is causing enormous work lockdowns in cities like Shanghai, which has 25 million people. While negative equity markets are never fun to report, we need to put this in perspective. In April, the S&P 500 was only off 5% from its all-time highs. This with inflation at 8.5% and a war in Ukraine. Looking at drawdowns over the last 40 years, the red dot shows the max drawdown for any year, and the gray bar is the full year return. you can see that in any given year, a 15 to 20% pullback is normal. And last year's 5% fall was historically very low. In 2022, we've already seen drawdowns near this 15% level. Before we look at fixed income, let's look at the US yield curve, with the yellow line showing 15 months ago, the orange line 3 months ago, and at the start of 2022, the blue line shows the curves as the end of Q1. It's quite evident that we've seen a dramatic shift in the level and the shape of the curve. It has risen across the board and by significant amounts in the short end, looking at the 1 and the 2 year sections, for example. The curve shifted higher and quickly as the markets priced in at least 8 rate hikes and an additional 200 basis points of hiking from the Fed this year. Again, let's remember just how quickly the sentiment changed. To start 2021, or 15 months ago, the futures market was pricing in the first rate hike in August of 2024. In September of 2021, so 8 months ago, there was less than 1 rate hike priced in for 2022. By December, there were a little more than 2 rate hikes priced in. By early March, there were 5 rate hikes priced in, but by the end of March, there were 9 rate hikes priced in over the next 15 months. Additionally, the Fed has signaled further tightening with balance sheet reduction at $95 billion per month. This is an extreme change in sentiment and expectations of tightening monetary expectations. Notice too that the yield curve is flattened. As the Fed hikes, we expect the economy to slow, and therefore the yield curve is flattened as you increase maturity. The sharp shift higher in the yield curve helps explain one of the worst bond quarters in my lifetime. Now turning to fixed income. It's rare to show a fixed income slide with this many negative numbers. In fact, this was the worst quarter for bonds in 40 years. The Bloomberg US Universal Index dropped 6.5% in Q1, with yields rising sharply as we just discussed. The US Treasury Index fell 5.6%, while the high yield sector fell 4.8%. Remember, the high yield sector is shorter in duration and also has the benefit of yield spread, which helps in a rising rate environment like we have now. The only positive number on this slide is the Bloomberg Commodity Index, up an eye-watering 25% on the quarter. This is the 4th highest quarterly rise in commodities since the index started in 1960. Of the top 10 quarters, most were in the 1970s. So this is a very difficult environment. Remember, the commodity index's largest component is energy at roughly 30%, and energy prices have risen sharply on the year. This, again, is part of the inflation theme that is one of the main drivers for 2022. In sum, there are now more headwinds than tailwinds for asset prices. There are positives, such as strong employment, earnings growth, still ample liquidity, and pent-up demand, especially for services. But investors are concerned about inflation, rising rates, and Ukraine. Importantly, there's a great deal of uncertainty around all three and the further impact they can have on the global economy.